Imagine this. While you're looking at this video title right now, the market is quietly screaming, unmistakably, something big is happening. This isn't just headline noise. This is a targeted shift that cuts straight into the core of the Bitcoin market. On February 9th, 2026, South Korea announced an entirely new regulatory dimension, an AI-driven surveillance initiative designed specifically to detect whales, coordinated movements, and sudden price manipulation. And if you think this is just another regulatory tweet, listen closely, because what starts now could impact price action, liquidity, and market psychology in real time. Bitcoin is no longer a simple asset. It's an ecosystem of wallets, flows, intuition, and, as we're about to see, algorithms. While you might think the market is wild and chaotic, whales have known this for a long time. The market is playing a game you don't see. And today, South Korea's financial watchdog announced that these hidden movements are now being placed directly under the microscope of artificial intelligence. The Financial Supervisory Service, the FSS, revealed in its annual plan that starting in 2026, it will deploy AI tools to detect suspicious coordinated buying and manipulative price behavior on a second-by-second basis. These systems aren't just looking for whale trades. They're scanning for API abuse, price fencing schemes, and even coordinated social media hype designed to artificially push prices higher. And this couldn't come at a more sensitive moment. Just last week, a technical failure at the South Korean exchange Bitham triggered an almost unbelievable event, where more than 620,000 Bitcoin were reportedly distributed by mistake, a theoretical value exceeding $40 billion, before most of it was clawed back. This kind of ghost coin event didn't just send local prices down more than 10% temporarily, it exposed just how fragile parts of the infrastructure still are. Historically, moments like this echo 2017 and 2020, periods when external shocks, from regulatory interventions to exchange incidents to sudden whale activity, triggered massive short-term liquidity shifts and panic selling. You might remember the final phase of the 2018 bear market, when whales quietly rotated positions while retail panicked. Exactly the type of psychological setup we could be walking into again. History doesn't repeat perfectly, but psychology always rhymes. While you panic, whales accumulate quietly. Here's the dramatic irony. While some traders believe they've figured the market out, AI surveillance has begun trying to decode market behavior itself. The FSS won't just monitor price movements. It will analyze text, sentiment, and social media data in real time to uncover coordinated messaging that often accompanies pump strategies. Imagine an algorithm reading tweets, forum posts, and order books simultaneously, flagging entire networks as suspicious. That's not science fiction. That's the reality of 2026. And that sends a chill through the market. Because if, within the next 6 to 12 hours, these systems detect coordinated buying, high volumes split across multiple large wallets moving price aggressively, regulators could trigger immediate pauses or even temporary trading restrictions on exchanges. And you already know what happens when buy pressure suddenly disappears. Liquidity dries up. Stops get hunted. Fear spreads. Chaos follows. The market doesn't explode, it implodes briefly. Now think back to earlier cycles. March 2020, when macro shocks triggered market-wide sell-offs almost instantly. Or the panic waves of 2024, when regulatory headlines repeatedly set off false alarms. Price structures broke, short-term bottoms formed, and then, quietly, whales stepped in again. Like a beach ball held underwater, forced down until pressure builds, and then violently released back to the surface. On the surface, the market feels unstable. Underneath, long-term positions are being built. Look at the current on-chain data. Whales, wallets holding more than 1,000 Bitcoin, have continued to increase their holdings over the past year. According to leading analysts, more than 1.8 million Bitcoin now sit in these large wallets, with weekly accumulation still in the 5-figure range. That tells you something important. Despite regulatory noise, persistent demand hasn't disappeared. The whales know exactly what they're doing. But this AI-driven regulation could force liquidity, not because it wants prices higher, but because it wants to prevent manipulation. And that's a crucial difference. Regulators don't want anyone, whale or otherwise, artificially pushing prices up or down without real demand behind it. In the short term, that can actually create volatility spikes, the very thing traders hate most. Now zoom out to the macro picture. Inflation remains a global issue, and institutional Bitcoin accumulation has increased again, especially as ETFs and corporate allocations re-enter the conversation. Countries like South Korea are now allowing companies to hold crypto on their balance sheets, creating a new flow of capital that didn't exist before. That flow is now colliding with a regulatory framework designed to smooth out violent waves. Psychologically, this is a perfect storm. You see charts, you see prices, but you don't feel the artificial intelligence in the background, analyzing every trade, every order, every message. The FSS AI acts like an invisible guardian, scanning large order clusters and raising alarms when patterns look coordinated instead of organic. And once an alarm is triggered, the market reacts, instinctively, irrationally, fast. You might be asking yourself, how does this affect Bitcoin directly? It means that sudden large moves that yesterday looked like normal whale activity could tomorrow be treated as suspicious behavior. And if suspicion leads to temporary restrictions, margin liquidations can cascade, prices can snap lower, and short coverings can ignite violently. An omega candle exploding while most people are still asleep. You need to understand this clearly. This is not a vague regulatory outlook for the future. This is a real-time surveillance infrastructure going live right now as you're watching this video. And it's specifically aimed at those with the most influence over price, the whales. That creates psychological tension across the entire market. Every major move could now be watched, analyzed, classified, and in extreme cases, interrupted. So if you're wondering how to respond, forget the hype narratives. Watch the trend lines, volume, accumulation, and on-chain flows. When large addresses keep accumulating while sentiment stays sour, that's not random, that's demand quietly forming. And if that same demand runs into short-term friction because AI flags it as suspicious, you know liquidity is being reshaped, not destroyed. Some of you will comment, will this destroy Bitcoin's price? No, but it will change how this market reacts in the short term. Expect abrupt moments of uncertainty, just like the famous capitulation points of previous cycles. Because historically, every sharp pullback has often marked the beginning of major accumulation phases. And if you really want to understand what's happening right now, don't just stare at price. Watch on-chain patterns, wallet structures, liquidity levels, option skew, and derivatives open interest. A system that flags suspicious behavior isn't just another news cycle. It's a new market paradigm. One where transparency increases for some, uncertainty rises for many, and opportunity expands for those who know how to read between the lines. So if you're out there feeling fear, FOMO, or just confusion, breathe. These are the moments that shape the greatest chapters in Bitcoin's history. In the coming days, AI will analyze every major movement in South Korea at machine speed. And while others ask, what's happening right now? You can say, I know what's behind it. And that alone puts you ahead of the crowd. If this perspective resonates with you, let us know in the comments what indicators you're watching right now. Do you think AI can really catch the whales? Or will it simply expose the chaos that was already there? These conversations are what make this community stronger. And if this analysis helped you see the market more clearly, hit the like button, because we're not here just to react. We're here to understand. At the end of the day, this headline moment isn't isolated. It's a structural shift in how the market operates, creating short-term volatility, but revealing long-term patterns of accumulation, transparency, and institutional participation. Remember this, when whales go quiet, the data speaks. And now, with AI watching them, the market is speaking louder than ever.